Welcome to the Private Equity Experience Podcast, your backstage pass to the strategies, stories, and secrets that drive value in the PE universe. No filters, no fluff, just straight talk and expert insights to help you navigate the private equity world with confidence. And now your hosts, Ed Barton, Rory Liebhart, and Emily Sander.
We should do some witty banter at the beginning.
Well, you normally start with the difficult question banter.
I know. I usually start with the opening question, but I had back-to-back meetings all day, so we're gonna roll with it's early August, let's say. I am excited and absolutely thrilled that football season is upon us.
Bring it on,
That makes
man.
me a very, very happy person.
Yeah, I can't wait.
Give you this whole seasonal life cycle.
Mm.
You know how people have SAD or seasonal affective disorder when the days get darker? Okay, so there's Christmas, New Year's, my birthday's in January, and then I take a vacation to Hawaii every February, and the Super Bowl's in February. After Super Bowl in February, I have AFD. After football disorder. I have I'm a mildly depressed afterward. And when the days start to get shorter on June 21st, which is the longest day of the year.
Oh yeah.
I get a little sad about the days getting shorter, but I'm happy because we're almost to football season.
Are you getting a little taste of that dopamine with the training camps going on and all that stuff?
Yes, OTAs have started.
Yeah.
Barton's the new quarterback.
Yeah, you get little nuggets there with the draft and all this stuff.
The draft is amazing. Yeah. We have preseason starting next Thursday.
Yeah.
Preseason games for the NFL start this weekend.
Yeah.
Oh my gosh.
Yeah. No, I'm pumped. I'm a college football guy. And that it kind of runs my life in the fall, to be honest with you. Yeah.
I used to be more college football until the NIL made it into free agency every year.
Yeah.
And now I'm a Notre Dame grad, so I generally it was a good season last year.
Yeah.
But it was one of those every year they go sign a new quarterback and so it's college football has changed enough. I definitely am now more of a Seahawks person than a college and I'm excited because I like the fact that they've gone to Clint Kubiak as the offensive coordinator and they're going to be running 22 offense, so you're going to have two tight ends, two running backs. You've got a fullback.
They're basically becoming the Ravens at this point. Yeah, which is good. It's a good place to be.
As well say, if you want to make the playoffs every year, and the Ravens are in the toughest division in football.
Yeah.
In the AFC Central. So
in the NFL, behind the Seahawks, the Ravens are my favorite team. They always have been. Yeah.
This is before preseason starts. Predictions for the Seahawks. I'm gonna go. They go they win 10 to 12 games, make it to the playoffs by winning the division, and then lose in their first or second playoff game.
So they make it to the divisional round, you think, past the wild card?
Yes.
If they win the division, they'll be in that game anyway. Yeah. So if they either they win their divisional game or they're
a wild card
and go to the champion NFC or the NFC championship or they're out. Yeah.
Yeah, you guys know me well, so I don't bet anything ever.
Me neither.
Until this year. So the first time I got on DraftKings, when they came out with the line that the Seahawks over/under on wins was 7.5.
What? You hit the over.
And I was like, I'm putting $300 down on this one for the over.
I mean, that's basically like buying another car, $300.
Yeah. It is for me. Yeah, that'll fund an entire another vehicle. And then they had will the Seahawks make the playoffs? And I said yes. So there's another $300. And I was like, look, to me this is that one's a little bit more speculative, but I'm going with a 10 to 11 win wild card.
Yeah,
I actually think the Rams have one last shot at the
Stafford.
division.
Yeah,
I think we make the wild card, and I think we win our first wild card game and lose in the next round.
Honestly, I think I'd take that on a parlay if I were a betting man. I'd link those together and probably see what I could get. Yeah, that's good.
Wait, so Ed, someone somewhere thinks the Seahawks won't win 7 games?
Won't win 8 games. They said 7.5. Yep, that was Vegas.
What?
that came out like right after the draft. And I was like, how do I do sports betting? Because they're like, this is ridiculous.
This is stupid.
I'm like, I would have really struggled with that last year. Because I'm like, okay, you've got new head coach, you got, but I'm like, they're all looking at like the DK Metcalf left and Tyler Lockett left and
more trouble than he's
worth. I was like, Geno Smith to Sam Darnold's a wash. I think I think they're about the same. And I'm like, DK Metcalf's a unique talent that never was able to put it all together, and then was always good for a personal foul or an unsportsmanlike conduct.
So many unnecessary penalties, more trouble than he's worth.
And then Lockett is, I'm like, you go Lockett to Cooper Kupp, and I'm like, to me, that's a wash.
And in Jigba, and Jigba's good.
And as the defense leveled up, I mean, that's
the same as last year. Yeah. And I'm like, and then you had, and I know, Rory, you're a big college football guy, but freaking. It just didn't work. It just didn't work with Ryan.
No,
Grubb.
I was surprised by that, honestly. The guy
was I, but I'm like, okay, now we're going to 22, baby. We're going to run like K9 behind a fullback. Exactly. And then you've got, blocking tight ends and all this other stuff. I'm like, this could go.
Yeah. No doubt. It'll be cool to see it unfold. Absolutely. And it's here.
We'll do some check-ins here as we go along the season.
Yes. Yeah.
Let me watch this segue. Here we go. So the Seahawks might not be too big to fail, but is private equity too big to fail? That's our question for the day.
Cases to be made for that. Yeah.
I mean, where have we heard this term before?
Well,
banks.
Yeah, banking. I mean, the last time we went through the financial crisis was, back in the 08, 09, and you had the too big to fail. And then it kind of bubbled up again when you had SVB kind of at the verge of, and the Fed came in and basically said, and the Treasury came in and said, no, we're not going to let them fail. We're going to orchestrate the sale of those banks. And, and we talked about that, I think, last pod before.
Orchestrate the sale or take a direct equity investment in it, or, put together bad asset facilities and stuff, which a lot of that stuff could easily be applicable to private equity, private credit, all of that stuff. The point is, I mean, there's 13 trillion of assets under management in these institutions now. So I would make the case that they are pretty critical to the, money movement and overall kind of fueling of the economy. I think 1 in 10 workers out there is working for a company that's private equity backed, which tracks to me for sure.
What makes something too big to fail, or what's the tipping point where it's like, hey, this is a thing in the market, but it's not too big to fail. Now, we got to save it. We got to bail it out.
So that's a political question.
I was just going to say,
with a political answer. So it's how many workers or depositors are going to get impacted by the failure? So when you go back to, and I'll go to the classic, and Rory will appreciate this because he's a bankruptcy guy. Yeah. So I go back to 2008 financial crisis, and the automakers all basically, now Ford, God bless him, had gone out prior to the financial crisis, raised capital.
That's right.
It was almost no luck from my perspective, but they raised capital so they didn't have to go through the federal government thing. But the two big automakers, so Chrysler and GM, basically had to file for bankruptcy. Well, they were too big to fail. So the government bailed them out, but they bailed them out by basically going, you're going to file bankruptcy, but we're going to reorder. In order to do that, you got to follow our rules, which are, because you're going to lay off too many folks, and it's going to screw up the pension plans, and it's going to screw up the unions. And so you're going to have to honor your union pension contracts, even though those should not have been honored in the bankruptcy. They should have gone to ERISA. You're going to have to keep certain levels of employment, even though normally you wouldn't. You're going to have to keep certain plants open, and you're going to have to shutter others. You're going to have to do. And so too big to fail is really like, and so they overturned what would be the normal bankruptcy preference process in order for payment, in order to, so they wiped out bondholders, they wiped out secured creditors, and they kept unsecured creditors in, but it depended on who it was. And I think private equity is in the same boat, where you've got, like Rory said, 1 out of every 10 employees works for a private equity backed business. That's a lot of votes. And so I think it's one of those where, the issue on private equity being too big to fail is the private equity is the way that they've structured their portfolio companies such that they cannot withstand kind of an economic crisis. They got too much leverage. They've got too much in the way of covenants, which then cascades down to the banks. So now you have private equity has created the failure because of how they've financially engineered the balance sheet.
They're so intertwined with the banks.
It's so intertwined with the banks, private credit, and 1 out of every 10 employees that there's an opportunity that the government will not let private equity. Now they might take the private equity general partners, and those guys are going to pay the price. But the limited partners who are pension funds and college endowments and state pensions, they'll probably be, we're going to help take care of you. The employees, we're not going to let y'all get out of work. And the banks, they can't let the banks fail. So I think it's the GPs will get exposed. Everybody else there's a lot of political capital there that they're not going to want to.
Yeah. But a couple of things on that too. I think what's different now that we've seen, going even more recently to 5 years ago, where the government had stepped in with stimuli of some sort, is like there seems to be a move more towards directly, supporting the consumer and letting the, surrounding businesses and things like that, wither and stuff, maybe a little bit differently than, basically propping up banks and business in the past. That being said, private equity is just an overall kind of industry. It's there are many firms out there, so I don't think it'd be a uniform thing. Every private equity group would be too big to fail, or but there would be some. There would be some that would be left to die. There would be some that would probably be supported. Like the Blackstones of the world, and Apollo, and some of the biggest ones out there. I think there's probably a case to be made that there's some major institutional risk if something like that tanked, but not sort of middle market, perhaps, so it's not so black and white, I guess, in that respect.
Well, you said major institutional risk, and I'm wondering, like, is there a threshold where this thing is so intertwined, this thing has so many workers involved or so many downstream impacts that it just reaches a tipping point? And then there's maybe a question of how do we do it? What conditions do we put on this thing? All these different maybe political aspects. But is there just a fundamental, this thing is so entrenched and foundational now that we can't not do anything?
Some of it really does come down to the sector coverage. I mean, I think there's probably some pretty big private equity funds out there, even ones where Ed and I have worked for their operating companies that are, basically buy distressed businesses and, distressed assets. I don't think that that's necessarily what the kind of business, PE group would be to prop up, but it's, others that are exposed to, manufacturing and other sort of, kind of healthcare, things like that. I think it's not going to be a blanket approach, by any stretch. And I think there has to be probably a careful view as to, what constitutes, systematic risk, as we say. What does it mean if you let a big PE fail? Like you're gonna affect a lot of pension funds and endowments and other LP institutions, but maybe that's not. Maybe that's contained to sort of domestic LPs. I'll just put it out there. Does the U.S. care whether, a sovereign wealth fund from the Middle East suffers the fate? I don't know. This is hypothetical, but these are things that come to mind when I think about how do you parse through who you let, kind of stay and who you let die.
Well, there's also, you mentioned political. There's just optics and sentiment where when the automakers were in trouble and Obama went in and saved them, but also put these conditions around, emissions and EV and all this stuff, there was a sentiment of you can't let Ford just die. That's not okay. That's not American. Is there a sense of, there's a different tone when it comes to PE versus some of these other industries? Is there optics to it?
Well, I would argue they're definitely not in the same political view as Ford per se, right? Like that's an institution. I think there's a perception of private equity out there that it's a opportunistic and, basically, can be harmful as much as anything in some ways for vis-a-vis those other institutions like banks and stuff, and other more traditionally viewed sources of funding, call it.
Yeah, I think as Rory noted, there is a real dynamic of the perception of the private equity. Again, the GP is going to be the one that's vilified.
Yeah.
And when things are going bad, politicians like to be able to point to somebody or something and go, it's your fault. It's not my fault, even though I structured a bunch of things that made this as an incentive for you. But it's not my fault. It's your fault, GP. And therefore you're going to end up with, kind of getting the hit. And, to your point, Emily, it was sad. It was sad for a car guy like me to see Pontiac die. I mean, that was required by the government. The government said, Pontiac, you're dead. Saturn, you're dead. Saab, you're dead. Now, Saab, less of a concern for me, but they basically killed out, like with GM, they basically said, they had a special working group from the government who was here to help look at all this stuff and say, as a condition, you're going to have to kill off these underperforming areas, et cetera, et cetera, et cetera. But it's General Motors, as Rory noted, that's a icon going back to, Alfred Sloan days.
It is American industry in a lot of ways.
And then you go over to, and I think you'd run into the same thing with steel, and you'd run into the same, especially with the current administration, who's kind of
I was just going to say,
around manufacturing.
Right.
But I don't think you're going to get that same.
Yeah.
You're not going to get that same feeling about BlackRock.
Right.
No.
Yeah. BlackRock, the group that, again, this is fact, buys up tracts of residential homes in massive swaths and, is able to sort of flip that to I mean, like, there's a perception, I'm not saying it's correct or not correct, about private equity that is, vulture-like, it's optically not the same thing as, saving, a banking system, for example, even, Bank of America, where everyone, goes to, deposit their paychecks and, take out little loans for, automobiles and things like that, whatever.
It's almost like PE as a group should hire like a PR firm to rebrand themselves or to have a new image, because then they'll have some different sentiment.
Well, they have lobbyists to do that.
Yeah.
Lobbyists, yes.
Maybe if that were the case, like if Mitt Romney would have become president back in the day, like that could have been a thing, because he came from the private equity space. One thing that's clear, though, is like the whole foundation of private equity is that it's not a bank, right? Like, because banks have been propped up because they're so close to, our government in a lot of ways, they're highly, highly regulated. Just the private equity model as a highly regulated set of entities wouldn't be the same thing. It would be completely different. It would be, lower yield and, much more, narrow in what it can do and can't do as a result of having those governmental protections. That's what the banks give up, is being able to be competitive with, groups like private credit funds and PE, because banks have to have a certain level of capital. Banks have to, adhere to certain regulations that came out of that financial crisis as a result of having to be propped up, so PE would become more bank-like if they were in that scenario, probably.
How did PE do for the 2008 financial crisis, for COVID? Like, were they resilient, or were they at the edge of?
Well, I would make an argument. Certainly, the PE group that Rory and I are working with, they actually helped the government in the 2008 financial crisis, because they went over to the
Merrill Lynch portfolio.
They went to RTC. They got their start like in the RTC world, back in, kind of buying up bank assets.
Yeah,
and so they provided liquidity for illiquid elements so that the government could get them off their balance sheet.
Yeah.
Now, they made a small fortune, large fortune doing that.
Sure they did.
But that was part of private equity in large part helped bail out the 2008 financial crisis for a profit. Of course, It was not an altruistic thing, but they provided the liquidity.
Yeah.
The COVID, I think COVID, we talked about this a lot. I think COVID actually is going to prove to be a disruptor the other direction, where asset prices went way up. The discount rate came way down, and they ended up overpaying for a bunch of stuff. And I think there's going to be a kind of a reckoning as to what the returns are going to be on those.
Yeah, the inherent risk premium should have been higher for sure.
Yeah. Oh yeah, it should have. And the challenge there was, when you've got everybody, when you got a lot of liquidity chasing too few deals, those concepts start going, it becomes a supply and demand thing. And you move off of your spreadsheet where you've got, okay, what's the beta, what's the risk premium, what's the risk-free rate? And you go, well, the risk-free rate's now zero because or negative because they've basically cut interest rates down to nothing.
Yeah.
To try and keep the economy moving. And so, you overpay in that moment. But that now that we've got a risk-free rate sitting up at like 4%, which the Fed chose not to make any changes to interest rates.
Yep.
That what's changed is that risk return component has gone up by 4%. And so you're now when you're doing your discount rate, the even if the risk premium has not changed, so it's 4% or 5% over the risk-free rate, the risk-free rate's changed substantially.
Yeah, that's right. Well, and then offset by that is, of course, the benefits one got if you're invested in the company from all the stimulus and PPP and all the loans that were forgiven, during that time. Like basically, U.S. Treasury was an ATM machine rather than taking out actual loans that you had to pay back. So, yeah, I mean, there's an interesting time for sure.
So you both got in the risk premium quota, ding, 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 for the episode.
Like 4 times.
Rory, can you explain, like in normal human language, what Ed was just saying with like the risk premium and the 4% and the da-da-da? Like, what does that mean in real life?
It just means that at a point in time, the price for assets was artificially low relative to the intrinsic value and should have been reflected with higher pricing based on the risk that is now going to be realized and come to bear.
Okay. Yeah. Ed is making a face like, how could you not have understood me? But
no. I mean, I was just sad that I wasn't the one asked to explain my own definition of.
What Ed meant to say was, okay, double barrel question for you. What would cause a legitimate PE crisis? And then what do you think would happen?
Gosh, it's a wonderful question. I think a shock to the capital markets where, somehow if there's variable interest rate debt on the books and interest rates moved up massively in a shock scenario that you couldn't really forecast or hedge for, then that would create a problem. Because I'd say the biggest inherent risk with the private equity business model, as we've talked about in our book and even on this podcast, is the use of leverage. Just leverage just means when the merry-go-round stops, somebody's got to pay the bill. And if it stops in a place where you can't afford to pay the bill, then there's problems.
Yeah, it's going to be a liquidity issue.
There you go.
Liquidity is going to be driven by, as Rory said, it's a shock to the capital market. So when you end up with decreased liquidity, so basically banks aren't willing to loan at certain rates in order to refinance debt, the interest rates start to go up. Essentially, it's a supply and demand issue. And so if you've got a supply of money and there's a high demand for it from a liquidity perspective, that's when interest rates rise.
Yeah.
And so that becomes, even if they do have the ability to refinance the existing debt, the issue will then be one of, they've either got to go back out to their limited partners and go, hey, I need more money because I've got to now de-lever these investments. So I need to put in equity, which is going to impact your return significantly. Or I'm refinancing, but I'm refinancing at a higher interest rate, which has higher debt service, which is going to impact the performance of the underlying asset. Now, again, most of these companies trade on an EBITDA multiple, so you don't have to factor in interest. So they're going to, arguably a private equity sponsor is going to go, yeah, I'm going to prefer to do that because I still get the same EBITDA, but the leverage is still there and the cash flow is now going out to the bank. And if you've got a larger financial crisis, your ability to be able to cover that debt service is going to be limited, because you're likely experiencing top line pressure as well at the portfolio company.
The fact of the matter is that the private equity is probably never going to be like the direct bailout, because the system is based on their borrowing. So banks, effectively, if you will, and other more regulated sources. So like, point is, the bailout would be to the banks to backstop what the obligation from PE, and I say PE meaning PE operating companies and all the like, have. There would be a direct bailout more to the banks than the PE sector itself. Now there may be some, as Ed talked about, some sort of retribution, or not. That's not the right word, but like there would be some means to go after the general partners in these businesses to basically try to make the government whole if it's going to bail out the banks that would then support private equity businesses and stuff. It would just be, I don't think that, I just think it would be somehow, some way, not a direct, hey, we're gonna bail out ABC private equity group. I just don't see that happening. Yeah.
So you said shock to the system. So is this a drastic increase in interest rates and or over a short period of time, or is what trigger it?
Yeah.
That would trigger it?
Yeah. And again, I don't know the likelihood of something like that happens. We're talking in big theoreticals all here, but
but theoretically that, like, if that somehow,
what could cause that, Ed? What do you think? Like, what would result in like just a spike like that?
I think it totally would be a combination. Yeah, it would be, an invasion of Taiwan.
Okay, that's exactly good point. I was going to say something geopolitical, but yeah, exactly.
Yeah, so an invasion of Taiwan would probably have a significant spike in, and then the other one would be a sovereign debt crisis, like U.S. sovereign debt crisis, where we fail to raise a debt ceiling.
Yeah,
and so now all of a sudden the risk on the, again, risk-free rate is generally driven by the U.S. Treasury.
Yes.
In theory, it's the U.S. Treasury bill, 30-day Treasury bill is the risk-free rate proxy. And so if there's a U.S. sovereign debt crisis, then the interest rates on those are going to spike. And as a result, you're going to see that cascade all the way through the system. And that's one that, if it's a debt ceiling issue, you may not know until the day that vote's taken whether it actually is increased or decreased, although the market will price in a probability, but it could go opposite of what you expect.
I'm trying to remember like the last time that happened to a country in the world. I mean, I'm sure it actually happens more than I think and get headlines for it. One that comes to my mind maybe like 15 years ago or something like that was like Iceland, where it really it completely failed in that regard. Yeah. Interesting.
What else do people need to know about PE being too big to fail or not? I guess we've assumed that.
I think the takeaway here is, PE is increasingly, and I'll throw private credit in there too, but basically sources of financing that aren't banks and things like that. It's so integral to the economy. There's so much interconnectedness. I mean, again, you talk about it from the standpoint of assets under management, meaning, companies that are owned, which then employ people, for which, 1 in 10 people work for private equity. It's really integral. It's not like a small part of the economy. It's massive, and it's global too. So, so I think anything, hitting the economy hard is going to affect, private equity just as much as it does, any other industry or source of financing, basically banks, etc. They're all tied together. It's all tied together is the point. It's like, it's all truly tied together. Yeah.
Yeah. I think the private equity situation, as best I could analogize it, would be, it is not going to be the first domino that falls.
Correct.
But it's going to be one of the dominoes.
Yeah.
And its portfolio. So it's not likely to cause the problem.
Right.
But it is likely to get impacted by, like Rory said, by any macroeconomic issue, and the dominoes may be falling this way, or they may be falling this way. And in 2008, they may have been falling both directions. The private equity was actually the domino where stuff fell, and it propped it up on both sides, in the case of some of the toxic assets.
Yeah.
But otherwise, you may, and again, that was my experience because I was in the financial services sector. But the other way, it's likely to get cascaded, and because of the leverage and because of the ownership structure, they're likely to have amplified downstream impacts to the portfolio. The portfolio companies are really what gets impacted.
Yeah.
And that's where that and the limited partners are going to be the ones that are impacted most. And they're also going to be the ones, if there's a bailout, if there's a too big to fail, it's going to be because of pension funds. So you got ERISA, and the government will pull themselves into the process because of ERISA, or it's going to be because you have a lot of workers getting displaced and there's a lot of leverage, and then they'll overreact and put a bunch of regulation in place to fix the problem.
It reminds me of those plants that you see the plant above the ground, and then there's this huge interwoven root system where if you try to pull this thing up, you're pulling up like your entire yard, and you just don't see all these connections until something horrible happens. Just out of curiosity, is there a PE firm? I mean, I think of like US-based PE firms. Is there a significant PE firm headquartered in another part of the world where if something happens to that one for geopolitical reasons or something else, it'll have a rebound effect to us? Or are we kind of the center of things and then it'll go the other direction?
No, there's PE firms worldwide. But I actually think your geopolitical impacts are going to be more your sovereign wealth funds than a PE fund overseas. So a sovereign wealth fund, like a lot of your petrostates, the Scandinavian countries, they have sovereign wealth funds. And if something happens there where they need to get liquid, that's going to be a geopolitical impact. And they've got investment, including investment in private equity, that it could cascade down through, the system. So I think it's, you have the Saudi sovereign wealth fund, which is one of the largest in the world, and maybe the largest in the world. And something happens in the Middle East because it's the Middle East. That could be a big issue.
Big time. Yep.
Gotcha. How likely do you think this is?
How likely do we think a 2008 level crisis is at this point in time? I kind of put it on the same levels. I mean, it'd just have to be a systematic failure. And I guess I never failed to be surprised by stuff happening like that. I think we watched that unfold, like a ship running into an iceberg, like people could see what was happening to the average consumer being over leveraged and yet, the system was still just propagating, debt. So again, I think the common thread is debt, right? Like I think these things are going to be, it's all about, what can be sustained as far as debt service go. And as soon as that collapses, then the whole system kind of collapses.
Yeah. Historically, about every 10 to 15 years, there's a significant crisis. As Rory noted, it's normally driven around debt. And the thought process going into it, just prior to it, is this time's really different because when it's not.
We humans are different because
it was one of, there's some classic joke that was like, as soon as the barber started giving investment advice, that's when like Warren Buffett's like, I'm out of the market.
Yeah. There's that movie. Oh my gosh. It's a famous movie where it has Jeremy Irons in it and like Demi Moore and all these people. And there's this famous scene where Jeremy Irons is like this head honcho hedge fund manager or whatever. And he's eating like dinner at a really nice hotel. And this guy's freaking out like, aren't you scared that this big thing is gonna happen again? And he's like, of course it will. Yeah. Like, what do you mean? Humans are humans. This is going to happen again. This whole cycle that everyone thinks is the most traumatic thing ever. It'll happen again. I'm counting on it. It was just
podcast, but I mean, everything in life seems to be cyclical in most cases, in nature and all of those things. So maybe that's a human trait. I'm not sure, but it seems to be. We're old enough now where we've been through a few of these things where we can point back to it and say, wow, this seems like it was before, but and I guess humans are a hopeful species of beings where, to Ed's point, it's going to be different in the future. It's going to be different. It's going to be different with AI. It's all good, like no worries.
Humans are a hopeful species. Let's round out. What do we hope for Seahawks preseason first game against the Las Vegas Raiders with the new quarterback, Geno Smith? Not quite the official game opener between Geno Smith and Russell Wilson. Remember that one when it opened our season? Right when we traded Russell, and then the first game they came to.
You wrote me off, but I didn't write back.
Oh my gosh! And at that point, I was professionally hating Russell Wilson pretty hard. I was like, I want to see you get sacked so many times, bro.
Oh man,
you left got too big for your britches.
Just got to stay healthy. Is all.
I'm unlimited. Who do you think is going to win our preseason game? I got to vote for the Hawks. Come on.
I actually think the Raiders are going to win because Pete Carroll's going to want to win, and Mike McDonald. So Pete Carroll and Geno Smith have a reason to come in here and kind of show they made a mistake.
True.
The folks that are here have a reason to not get injured and to make sure that we kind of play that. So I think it's going to be the Raiders. I think Pete Carroll he's like one of the finest coaches that I've kind of, and I've been exposed to a number of coaches firsthand, as well as, kind of been a student of the game for a long time. He is one of the classiest, coolest, exceptional coaches. The only time I didn't like him was because I'm a Notre Dame guy, was when he was at Southern Cal. So I was glad he left Southern Cal. But, I would not mind seeing Pete Carroll go out with a win at the end of the season, or see the Hawks and the Raiders in the Super Bowl. I'd like to see Pete Carroll successful.
How cool would that be?
In Las Vegas, but I can't root against the Hawks, but I think Vegas pulls this one off.
I met Pete Carroll once. Did I tell you that?
No.
So we were it was actually during G2, and we were at one of our baseball games, like the work baseball thing. And we were playing against the facilities people of the stadium, and to support the facilities people, Pete Carroll came and just played like one inning. And I actually tagged him out, and he was like, "Good ball, good job." And
no way.
And I was like, "Oh, wow. Yeah." And he was just doing that to support his people. He played one inning, hit the ball, ran, and then left. But
he was probably 65 at that time too.
Oh yeah, no, he was. I mean, he
was
an
animal. He's so impressive.
But
the only guy I ever met was the one it was at G2, and it was Mike Holmgren at the QFC in Bellevue. Near the office. Mike and Kathy Holmgren were in there.
He was hard to miss. He's a big man.
Big dude. Yeah, he's a big dude.
Cool guy.
A large man.
Yeah,
okay.
Dude.
All right. So we're going with the Raiders are going to win the preseason game, but the Seahawks are going to play it safe and smart, not get injured, so we can rock and roll in the official season.
Yeah,
that's
what we're
landing.
Seahawks go. I think it was consensus. Seahawks go to the playoffs with the three of us.
Yep.
Right?
Yep.
Well, Rory didn't opine.
No, I was on the bandwagon for sure. Yeah. Yeah.
Beautiful.
I won't belabor I won't saddle this conversation with prognostications on the Washington Huskies. I'll keep that to myself.
Yeah. We'll do that next time. Thanks, Rory.
Yeah.
Thanks, Ed.
See you guys. Bye-bye.
Toodles.
If you enjoyed today's episode, please like, share, and subscribe wherever you get your podcasts.